So, you're 60. You've spent decades on the tools, behind a desk, running a business, or working shifts. Your super balance finally looks healthy, and you're thinking, that's it. I'm done. Before you hand in your resignation, there's one number that could completely change your retirement plan. It's 7 years. The 7-year gap between accessing your super and becoming eligible for the age pension is where many Australians unknowingly burn through hundreds of thousands of dollars. Most people don't realize how expensive those 7 years can be until it's too late. Today, we are breaking down what I call Australia's 7-year retirement gap. You'll meet two Aussies, Davo and Macka, who made one different decision that changed their financial future. By the end of this video, you'll know why retiring at 60 isn't always the smartest move, what mistakes Australians keep making in 2026, and how to protect your retirement without working forever. This is Money Mate. Let's break it down. Quick disclaimer, this video is general information only and isn't personal financial advice. Everyone's situation is different, so always consider professional advice before making major financial decisions. Here's where most people get caught out. Many Australians hear that they can access their super from age 60 and assume that's the finish line. It isn't. For most people, the age pension starts later, creating a gap where you're funding your own retirement. Let's use a simple example. Imagine you've built up $500,000 in super. Sounds like plenty. But if you're withdrawing around $60,000 a year to cover everyday living expenses, mortgage repayments if you still have one, groceries, insurance, fuel, holidays, rates, electricity and everything else, that money starts disappearing much faster than most people expect. Over 7 years, that's around $420,000 in withdrawals before investment returns, fees, and inflation are even considered. And remember, life doesn't suddenly become cheaper after you retire. Power bills still arrive. Car repairs still happen. Insurance premiums keep rising. Groceries don't stop getting more expensive. Inflation keeps moving whether you're working or not. The question isn't whether you can retire at 60. The question is whether your money can comfortably support you for the next 25 or even 30 years. Here's something many Australians overlook. When you stop working, your employer generally stops making super guarantee contributions. That means you're no longer adding fresh money into your retirement savings. Instead, you're taking money out. And every dollar you withdraw is a dollar that's no longer invested and compounding for your future. Compound growth becomes incredibly powerful during the final years before retirement because your balance is usually at its highest. That's why retiring even a few years earlier can have a much bigger impact than people expect. Another thing to consider is investment risk. If markets fall early in your retirement and you're forced to keep withdrawing money, your super has less chance to recover. Financial planners often call this sequencing risk, and it can significantly affect how long your retirement savings last. The goal isn't just to build a big super balance. It's to make sure that balance lasts. Let's compare two fictional Aussies. Both are 60. Both have around $580,000 in super. Both want to retire. Davo decides he's had enough. He retires immediately. He withdraws around $65,000 a year to fund his lifestyle. 7 years later, his balance has fallen dramatically. Now he's relying much more heavily on the age pension. Every unexpected expense feels stressful. Replacing the car? That's a major decision. A big dental bill? That hurts. Helping the grandkids? Not always possible. Now let's look at Macka. Instead of stopping completely, he cuts back to 3 days a week. His part-time income covers most of his day-to-day expenses. His super stays invested. He continues receiving employer super contributions while giving his investments more time to grow. By the time he reaches pension age, his retirement savings are significantly stronger. Same starting balance. Same country. Same economy. Just one different decision. One has more financial flexibility. The other spends every year worrying whether the money will last. So what's the smarter approach? It doesn't necessarily mean working until you're 70. It means making retirement work on your terms. First, consider easing into retirement instead of stopping overnight. Even 2 or 3 days of work each week can cover everyday expenses and reduce pressure on your super. Second, think about your housing. For many Australians, their family home is their biggest asset. Downsizing isn't right for everyone, but planning ahead can free up capital and may allow eligible Australians to boost their retirement savings through measures like the downsizer contribution. Third, keep investing in your health. Retirement should give you freedom, not medical bills. Staying active can improve both your quality of life and reduce long-term healthcare costs. And finally, build flexibility into your retirement plan. Markets change. Inflation changes. Governments change policies. A good retirement strategy isn't built for today's economy. It's built to survive tomorrow's. One of the biggest myths in Australia is this: once I own my home, I'll be fine. Owning your home certainly helps. But your house doesn't pay your electricity bill. It doesn't buy groceries. It doesn't fill the car with petrol. Unless you're planning to sell it, downsize, or access its equity, your home isn't generating retirement income. Cash flow matters. That's why having a realistic spending plan is just as important as having a large super balance. Retirement isn't about having the biggest number on paper. It's about making sure your money keeps working for you. So, should everyone avoid retiring at 60? Not at all. If you've built enough wealth, understand your spending, and have a solid retirement strategy, retiring at 60 might be the perfect choice. But don't retire simply because you've reached an age. Retire because you've reached your number. Run the numbers. Understand the gap. Plan for inflation. Plan for healthcare. Plan for unexpected expenses. Future you will be glad you did. If this video helped you, give it a like so more Aussies can avoid costly retirement mistakes. Subscribe to Money Mate for practical Australian finance tips every week. And let me know in the comments, what age are you planning to retire, and do you think you've got enough? Thanks for watching, and I'll see you in the next one.